Everyone is a cryptocurrency newbie at some point, but that doesn't mean we all have to make the same beginner mistakes. Here are 7 deadly crypto sins for you to avoid and save yourself the hassle. Number 7. Trusting, not verifying. Every source of information has an agenda. Sometimes that agenda will involve accurately educating you to the best of the source's ability, and other times it will involve purposefully misleading you. Some sources will even think that they are passing on good information, but will have let their conflicts of interest cloud their judgment. That's why it's up to you to verify factual statements using original sources, question assumptions and opinions that are given without factual support, and look for conflicts of interest, not as reasons to disqualify information by default, but as reasons to be extra skeptical when you need to be. That even goes for this video. As we go through our 6 remaining crypto sins, feel free to do your own research, fact-checking, and forming your own opinion as we go. Number 6. Not backing up your wallet. Cryptocurrencies like Bitcoin put you in control of your money. With that control comes certain benefits. For example, no one can freeze your account, no one can forcibly seize your funds, and no one can block your payments. That control also brings with it the need for personal responsibility. Your funds exist on the decentralized ledger called the blockchain, and your private keys, stored in your cryptocurrency wallet, give you the ability to spend those funds by signing transactions. If you lose access to your private keys due to loss, theft, or damage, you lose access to your money, and it's lost forever. There's no blockchain support hotline or identity verification process to get it back. That's why it's pivotal that you back up the private key of any wallet where you want to store more cryptocurrency than you can afford to lose. Most wallet software allows you to back up your private key by writing down some number of seed words. You can then regain access to your funds by importing those seed words into another wallet. Number 5. Mixing up different forks of one original blockchain. Bitcoin is governed by open source software that anyone can run and modify. But since Bitcoin is a network, changing your version of the software doesn't do you any good unless you can get others on the network to agree with your changes. When a blockchain's community can't agree on what changes should or shouldn't be implemented in the software run by the network, one way for that conflict to be resolved is for the blockchain to undergo a hard fork split, where both sides of the argument implement whatever changes to the network they think are appropriate, resulting in 2 separate chains that share a history up until the split. One prominent example of such a situation was when Bitcoin split into Bitcoin Cash, ticker symbol BCH, and what many still refer to as Bitcoin, but we refer to as Bitcoin Core, ticker symbol BTC. Usually, all private keys, addresses, and unspent coins from before the split will be valid on both sides of the forked chain, making it possible to send, say, Bitcoin Cash to an address generated by someone who wants to receive Bitcoin Core. Of course, the coins do not end up on the Bitcoin Core blockchain. They end up at the same address, but on the Bitcoin Cash blockchain. Mixing up forks like BCH and BTC can sometimes be a mild inconvenience, and other times lead to a complete loss of your funds. The private keys that generated a Bitcoin Core address can always be imported into a Bitcoin Cash wallet, which can then usually move the funds. Problem solved. But sometimes that's not possible. For example, Bitcoin Cash sent to a segregated witness address is unmovable, since segregated witness was only implemented on Bitcoin Core. Other times, the receiver will simply be unwilling to go through the trouble of sending you back your coins, as is often the case for exchanges. So, when communicating about cryptocurrency, keep in mind that terms vary and chains sometimes split, resulting in ambiguity you'll need to keep an eye out for. Number 4. Storing all of your funds in a hot wallet. As we've already mentioned, it's your private keys that let you spend the cryptocurrency you own. But anyone else with access to your private keys can spend your money too, without your permission. Any wallet that stores its private keys on a device that connects to the internet is referred to as a hot wallet. For example, desktop wallets and mobile wallets store your private keys on your device's storage, and that storage may or may not be secure, depending on your device's software and your personal security-related habits. In order to protect your cryptocurrency from hackers who would try to compromise your device, you can instead store the majority of your funds in cold storage. That is, a wallet whose private keys are never exposed directly to the internet. There are many different cold storage solutions, each with their own benefits and trade-offs, including hardware wallets, paper wallets, and even fireproof and flood-proof solutions where your private keys are stored in durable metals. Number 3. Storing your assets on an exchange. When storing your coins on an exchange or any custodial service where you don't have the private keys that control your money, you're trusting that custodian to both give the money back to you when you want it and keep the money safe while it's in their custody. Since exchanges hold large amounts of cryptocurrency for their users, they are actively targeted by hackers and thieves. Hundreds of millions of dollars worth of cryptocurrency has been stolen from exchanges in 2019 alone. Untrustworthy exchanges have also been known to exit scam, taking whatever money is currently deposited on their platform and running, hoping to get away with it scot-free. You can avoid having your money disappear due to hacks and exit scams by only using exchanges to trade, and then withdrawing your funds to a wallet you control as soon as possible. Number 2. Trying to time the market. The cryptocurrency markets are largely unregulated. Regardless of whether you think that that's a good thing or a bad thing, it means that they can be manipulated by large players to siphon money away from day traders and retail investors. You may be tempted to buy when you see the price going up, or sell when you see the price going down, or even vice versa. But there is a good chance you will lose money trying to buy low and sell high. The safest way to enter the market, if you decide to invest in cryptocurrency, is by dollar cost averaging, where you invest a fixed amount at regular intervals. This protects you from short-term price swings, and you still profit if the prices go up in the long term. Number 1. Investing more than you can afford to lose. While we at Bitcoin.com are optimistic about the potential for digital currencies to bring about a new worldwide financial paradigm, the technology and ecosystem are still relatively young, and the markets are incredibly volatile. It's technically possible for any cryptocurrency's price to drop by any amount at any time. If you invest more than you can afford to lose, you are gambling with your well-being and the well-being of anyone who depends on you. So before you decide to invest, ask yourself, if every cent I want to invest disappears tomorrow, will I be okay? That wraps up our list. Have you committed any of these 7 deadly crypto sins? Let us know how it went in the comments below. And don't forget to like, subscribe, and hit the bell icon to be notified of new videos from Bitcoin.com.